In 2026, the cost of your health insurance could suddenly and dramatically shoot up. In some cases, by more than $22,000 for the year. This isn't a maybe. This isn't a worst case scenario. This is what's scheduled to happen if Congress doesn't act. There's a critical piece of policy that has kept health insurance affordable for over 24 million people since 2021, and it's set to expire at the end of 2025. If it does, it will trigger what many are calling a subsidy cliff, a moment where the financial help you get to pay for insurance could shrink dramatically or just vanish entirely. A KFF analysis shows that the average out-of-pocket premium for people getting these subsidies is estimated to more than double, jumping by 114% from one year to the next. This isn't just about numbers on a spreadsheet. It's about real families facing impossible choices. Imagine a couple in their early 60s in West Virginia, watching their annual premiums surge by over $22,000. Or think of a young person in Kansas whose yearly premium cost could jump by over 150%. These are the kinds of scenarios experts are modeling, and they are terrifying. Insurers are already bracing for this. They proposed a median premium increase of around 18% for 2026, partly because they expect these subsidies to disappear. They know that as prices skyrocket, healthier people will likely drop their coverage. That leaves a smaller, sicker, and more expensive group of people to insure, creating what experts worry could become a death spiral that drives up costs even more for everyone who's left. But this isn't a video about fear. It's about getting prepared. While the fate of these subsidies is in the hands of Congress, you are not powerless. You have more than a year to understand what's coming, figure out your personal financial risk, and take concrete, legal steps to protect yourself. The clock is ticking, and the time to start planning is now. So to understand the potential price shock of 2026, we first need to look at how the system works right now. The Affordable Care Act, or ACA, helps people afford insurance on the marketplace through what's called a premium tax credit, what most of us just call a subsidy. Since 2021, thanks to the American Rescue Plan and the Inflation Reduction Act, these subsidies got a major boost. These enhanced subsidies did two huge things. First, they became more generous for people who were already getting them. Second, and this is the big one, they got rid of the subsidy cliff. Before, if your income went even $1 over 400% of the federal poverty level, you lost your entire subsidy. You'd go from getting thousands of dollars in help to getting absolutely nothing. The enhanced subsidies fixed that. They set a new rule. Nobody would have to pay more than 8.5% of their household income for a benchmark silver plan. This created a smooth, predictable sliding scale. If your income went up a little, the amount you paid for your premium went up a little. It was manageable. All of that could end on December 31st, 2025. If Congress doesn't pass a new law, we go right back to the old rules. The 8.5% income cap vanishes, and that subsidy cliff comes roaring back. Think of it like this. The current system is like walking up a gently sloping hill. But in 2026, that hill could suddenly end at a sheer 1,000-foot drop. That drop is the subsidy cliff, and the edge of that cliff is set at exactly 400% of the federal poverty level. Let's put that into real numbers. For 2026 coverage, 400% of the federal poverty level, FPL, for an individual is projected to be around $62,600. And for a family of four, it's about $128,600. If your income in 2026 ends up just a tiny bit over that line, any financial help you were getting could completely disappear. It's a double whammy. You wouldn't just lose your subsidy, you'd also be stuck paying the full price of a premium that's already rising. This isn't a small tweak. It's a fundamental change to the financial math that has made insurance possible for millions. And the people who will feel it the most are the ones who can least afford it. The numbers behind this potential subsidy cliff are staggering, and they show just how severe the financial pain could be. Let's look at a few examples, based on projections from policy experts at KFF. First, think about a pre-retiree couple, both 60 years old. They're too young for Medicare and get their insurance on the ACA marketplace. Let's say their household income is $85,000 a year. Right now, with the enhanced subsidies, their premiums are affordable. But in 2026, that $85,000 income would likely push them just over the 400% poverty cliff. According to a scenario modeled by the Kaiser Family Foundation, this couple could see their annual premium costs surge by more than $22,600. Let that sink in. Their health insurance bill could be over $22,000 higher for the exact same coverage. For many people, that's more than their mortgage. Now let's look at the average person getting a subsidy on the marketplace. They might not be right at the cliff's edge, but they'll still feel a huge shock. KFF estimates that if the subsidies expire, the average annual premium paid by a subsidized enrollee will more than double, jumping from an average of $888 in 2025 to $1,904 in 2026. That's an average increase of 114%. What would you do if one of your essential monthly bills suddenly doubled? That's the question millions of people may have to answer. For an individual making around $28,000, their required premium contribution could jump from about 1% of their income to nearly 6%, costing them over $1,200 more per year. This cliff effect is especially dangerous for freelancers, gig workers, and small business owners, people whose income can swing up and down. In the current system, if you have a good year, your subsidy adjusts smoothly. But in 2026, one extra project could push you over the 400% FPL line and cost you thousands of dollars in healthcare support overnight. It creates a bizarre incentive to earn less money just to avoid a massive financial penalty. On top of all this, insurers are pouring gasoline on the fire. They are already proposing significant rate hikes for 2026. One analysis of early filings found a median proposed increase of 18%. Insurers say it's because of rising medical costs, but they also admit that part of the increase is because they expect these subsidies to expire. They figure that when prices shoot up, younger, healthier people will be the first to drop their coverage, deciding they can risk going uninsured. This leaves a riskier, more expensive group of people in the insurance pool, which drives up costs and premiums for everyone who's left. It's a vicious cycle that could start the moment these subsidies end. This situation is serious, but it's not hopeless. The key to surviving the 2026 price shock is to stop thinking of it as a problem for next year and start treating it as an urgent financial project for right now. This is your 2025 Financial Fire Drill, a 5-step plan to get ahead of the cliff and protect your wallet. Step 1, know your magic number, the MAGI Masterclass. The entire subsidy system boils down to one number, your Modified Adjusted Gross Income, or MAGI. This is not your salary. It's a specific calculation that starts with your adjusted gross income, AGI, from your tax return and adds back a few deductions like tax-exempt interest. For most folks, your MAGI and AGI are very close. This number is everything. Your eligibility for subsidies, how much you get, and whether you fall off that cliff all depend on your MAGI. Your first job is to find this number on your latest tax return and understand what goes into it. Step 2, become a fortune teller. Run the scenarios. You don't have to guess what your 2026 premiums might look like. You can get a surprisingly clear picture right now. Go to an online tool like the KFF Health Insurance Marketplace Calculator. First, put in your current info to see your 2025 subsidy. Then, run the numbers again, but this time, tell the calculator to use the old rules before the subsidy enhancements. The difference between those two numbers is your personal potential price hike. Seeing it in black and white makes the problem real and gives you the motivation to act. Step 3, the MAGI diet. How to legally lower your income. If you're anywhere near that 400% FPL subsidy cliff, your main goal for 2025 is to get your MAGI under that line. Luckily, there are perfectly legal and financially smart ways to do this. The most powerful tool for most people is contributing to pre-tax retirement accounts. Every dollar you put into a traditional 401k, a traditional IRA, or a SEP IRA if you're self-employed, reduces your MAGI by $1. If you think you'll be $5,000 over the cliff, putting an extra $5,000 into your traditional 401k could solve the entire problem. Just remember, contributions to Roth accounts, like a Roth 401k or Roth IRA, don't lower your MAGI because they're made with post-tax money. Another amazing tool is a health savings account, or HSA. If you have a qualifying high-deductible health plan, you can contribute to an HSA. These contributions also directly lower your MAGI. For 2025, you can contribute up to $4,300 for an individual or $8,550 for a family. If you're 55 or older, you can add an extra $1,000 as a catch-up contribution. Combining retirement and HSA contributions gives you serious control over your income. If you're a business owner or freelancer, you have even more options. You can maximize business expense deductions or strategically time your invoicing to push some income into the next year. Step 4, reevaluate your plan choice. The health plan that's perfect for you with a big subsidy might be a terrible choice without one. In 2026, you might need to completely rethink your approach. If you lose your subsidy, a fancy gold or platinum plan could become way too expensive. It might be time to look at bronze or silver plans. They have lower monthly premiums, but higher out-of-pocket costs. It can feel like a downgrade, but it might be the only way to stay insured and protect yourself from a truly catastrophic medical bill. Some people might even have to consider catastrophic plans, which are designed purely as a safety net against worst-case scenarios. The goal has to shift from finding the best coverage to finding the most sustainable coverage for your new financial reality. Step 5, make a calendar date, your mid-2025 strategy session. This is the most important step. Do not wait until open enrollment in November 2025 to start thinking about this. By then, most of your income for the year is already locked in, and your options for lowering your MAGI will be extremely limited. Sometime in the summer of 2025, you need to have a strategy session with yourself, your partner, or a financial advisor. That's when you project your year-end income and see if you're in the danger zone. That's when you can still make big moves like dramatically increasing your 401k contributions for the last few months of the year. Action in the middle of the year is powerful. Action at the end of the year is often just damage control. This price shock may be coming, but panic is not a plan. Preparation is. By taking these 5 steps, you can move from a position of anxiety to a position of control. This is a moving target. Congress could still decide to act even at the last minute, and the rules could change again. To stay on top of any developments, make sure you subscribe to this channel and hit the notification bell. This is one update you won't want to miss. To help you with your financial fire drill, I've put together a free downloadable MAGI reduction checklist. It walks you through all the income lowering strategies we just talked about. The link is at the very top of the description below. Download it, use it, and start planning today. The potential health insurance price shock of 2026 is one of the biggest, most predictable financial hurdles facing millions of American families. If the enhanced ACA subsidies expire, it could trigger an affordability crisis, with average premiums for many poised to more than double. We've seen the scenarios. Proposed rate hikes of 18% from insurers, and real-life examples of families facing premium increases of thousands or even tens of thousands of dollars a year. But the main takeaway here should not be fear. It should be empowerment. The subsidy cliff is a real risk, but you have the time and the tools to build a bridge over it. It all starts with understanding that your modified adjusted gross income is your secret weapon. It continues with planning throughout 2025, not waiting until the last second. By using pre-tax retirement accounts, HSAs, and smart financial management, you can actively work to keep your income below that cliff and hold on to the support you need. The changes could be coming, but you have more than a year to get ready. This isn't about politics. This is about your personal bottom line and your family's health. You have the information. Now is the time to act.